Lumen can provide a 100% return in 4.5 years through cash flows and in 9 years through dividends. This is a 22% cash flow yield and an 11% dividend yield. In this video, I will explain the high return potential of this company and why Warren Buffett would consider this a cigarette butt. Business overview and operating plan. Lumen is a utilities company providing internet and phone connectivity. They also own and operate high-speed internet infrastructure. The company's current plan is to take money from the declining landline phone business and invest this money into building out high-speed internet, cloud, and data security services. The legacy businesses will be harvested for cash flow until they are able to be sold off, repositioning the company to the most profitable sectors. This business is a product of a 2017 acquisition. As a result, we will focus on the 2018 onward financials. We can see here that there is more than enough cash flow to cover the dividend. Additionally, the company has been buying back stock. The earnings of this company are being heavily influenced by large depreciation, hence the lower net income number and earnings numbers we see compared to free cash flow. The business was and still is highly indebted. As of Q2 2022, the company has $27 billion of long-term debt, but the company has high earnings before interest, tax, depreciation, and amortization, known as EBITDA, and has been actively paying this down. This company has a 4.5 debt to EBITDA ratio on $6 billion of EBITDA. This is a little high and is below the 3x that is generally the accepted rule. The company is also actively divesting businesses, and after the current transactions close, $7 billion of cash will be available to pay down debt. This would leave the company at a 3.3 debt to EBITDA ratio, which is much more manageable. However, I like this comment from Seeking Alpha contributor Bill Maurer, suggesting the company should allocate $2 billion to buy back the undervalued stock or issue dividends, and I will be including this possibility in my analysis. This company is only a $9 billion company as of today. Therefore, a possibility of 22% of the company being purchased or distributed to shareholders is a large return hard to be ignored. Warren Buffett's cigarette butt. Warren Buffett refers to companies like this as cigarette butts. These companies are boring, forgotten companies that may be leading towards death, but there is still a lot of value left in the business. Previously, this business was very overvalued. Lumen is the product of an acquisition by CenturyLink of Level 3 Communications. CenturyLink was a highly indebted, overvalued company whose shareholders depended on an unsustainable dividend. Once the dividend was cut, investors fled the stock. However, as Buffett says, be greedy when others are fearful. Lumen is currently trading close to its 52-week low with $3 billion of cash flow generation on a $9 billion market cap. I will only account for $2 billion of cash flow moving forward to be extremely conservative. Throw in the potential to purchase or distribute a significant sum of money, and the potential to make your money back quickly is hard to ignore. Financial modeling. Moving this into a financial model, I am going to first go with the payback period model. This is a very simple model, but for a company where we are prioritizing getting our money back, I think it is a good place to start. As we previously said, the company delivers approximately $2 billion of cash flow. At a $9 billion valuation, this is 4.5 years. This is very good and leaves a lot of downside protection. Dropping our cash flow expectations by 50% to $1 billion a year, we get a payback period of 9 years. This is not a long time period. Next, I will be using a dividend discount model. This is similar to the payback period model, but provides a value for the company based on the cash flows received and a required rate of return. Although this company is a utility company with relatively stable cash flows, the company has been mismanaged historically. Thus, I am requiring a 12.5% return. The dividend discount model takes the dividend and divides it by the required rate of return. As the dividend is secure compared to the cash flows of the business, even if they are declining, I feel confident in doing this. The current dividend of $1 divided by 12.5% is $8. The stock currently trades for $8.80 a share. However, let's also consider the potential for an additional $2 billion of cash flow after the transaction. This equates to an additional $1.93 coming to the shareholder. I believe the 80-cent premium is justified given how much potential this transaction unlocks for shareholders. The current return this investment would have without this possibility is 11.4%, which I am quite happy with considering it comes purely from dividends. The final way I would like to look at this company is again with the dividend discount perpetuity model, but utilizing cash flows and growth as well. The cash flow should eventually return to the shareholder either through growth, dividends, or buybacks. Returning free cash flow is a large priority for the company. The reason I am now considering growth in this model is because the company has had negative growth, and I want to capture this. However, I want to take this opportunity to talk about Lumen's growth opportunities as well. Lumen is building out data centers and other edge cloud-related services. As we know from Amazon AWS, cloud can be very profitable. While you wouldn't think of an old utility provider to be a provider of cloud services, their unique position as the infrastructure provider allows them to provide services where network responsiveness is critical. Thus, we could actually see future growth from Lumen as their high-speed internet services become more critical to how we live our lives. In Lumen's slide deck, they show the very real examples of speeding up customer checkout, real-time promotions, and augmented reality work. While these technologies are in their infancy, Lumen is uniquely set up to provide security, internet, and cloud computing to businesses in which speed will affect the customer experience. For example, scanning something at a grocery store. The capability may be too slow to be a good experience on another service, but Lumen would be able to provide a result faster through its integrated infrastructure. If the response is instant, you are more likely to adopt the service. With this said, let's first see what our downside is. Let's factor a 5% decline in cash flows a year. With this model, we would take the required rate of return and subtract the growth. Except the growth is negative, so this actually adds to our required rate of return, and we end up dividing by 17.5%. 2 divided by 17.5% is 11.42. At a valuation of $11.4 billion as our worst case scenario, we have an approximate 27% upside. A neutral case of 0% growth gives us a $16 billion valuation and 77% upside. Finally, let's factor in 1% growth for if their growth plan works. I think we can see from the previous numbers the company is already a decent value, and I don't want to be too aggressive. The expected value of the company is $17.4 billion with these assumptions. That is a 93% return. Lumen is the definition of a Warren Buffett cigarette butt. It is a boring company still putting out good cash flows that people have left in the ashtray when it still has one last good drag left. One last highly profitable good drag. The almost 100% upside shows the stock has the ability to return cash to shareholders quickly. I frequently get the question, what if the stock doesn't go up to the fair value you calculate? I hope this can be answered by walking through the scenario of a 50% downside to this stock, assuming its economic situation has not changed and assuming the possibility of a $2 billion buyback is a certainty. We will also assume the buyback does not put upward pressure on the stock, given people are selling it down 50% for no reason. By understanding how a buyback works, we can learn how the downside on this company is minimal. Further stock deterioration from here will only make stock buybacks more valuable. This sets a price floor on the stock. Let's walk through this in practice to ensure we understand this. The company sits at a $9 billion valuation, and today we buy 10,000 shares for $8.80 each. This would cost $88,000. The value then declines 50% with no economic change in the stock. The company is worth $4.5 billion, and our shares are now worth $44,000. The company could then take the $2 billion from the upcoming transaction and purchase almost 50% of the company. This would leave $2.5 billion worth of outstanding shares available and boost our relative ownership of the company. This is because there were approximately 1 billion shares outstanding, and the company purchased and retired 454 million, leaving 546 million shares remaining. But I still own my 10,000 shares. I now own 80% more of the company, although I've suffered a 50% paper loss and my shares are only worth $44,000. However, let's assume the company still pays out $1 billion in dividends. There are now less shareholders. Previously, this would have been $1 a share, but with fewer shareholders, we now receive 80% more as we own 80% more of the company after retiring the $2 billion worth of shares the company bought back. This would boost the dividend to $1.80 a share. Although the stock is down 50%, we are still getting a dividend of $1.80 a share on our initial $8.80 a share investment. This is a 20.5% return. We are now receiving $18,000 in dividends. So while our shares on paper are only worth $44,000, we won't sell them as we are getting a nice dividend. In 5 years, we would have all of our initial investment back. However, in this example, if the stock refused to budge, the company could again purchase $2 billion of the $2.5 billion of remaining stock and further increase our ownership of the company. If the stock refused to go up during this buying, our annual dividend after this scenario would be $9 per share a year, more than our initial investment. This is why a stock's value reverts back to its fair value and does not stay undervalued for long. The company can purchase the shares back and dramatically increase the current shareholder value. I hope this helped explain how share buybacks can provide a price floor to a stock and that you got value on this amazing upside potential from Lumen. Please leave a comment on what you think I got wrong during this video. I'm happy to get feedback. Leave a like or a comment if you found this useful and maybe consider subscribing. Bye!